Welcome, everyone, to another episode of Lender Lounge with Kevin Kim. Thank you for joining us. Today, we've got one of my favorite clients and a good friend of mine, Greg Hebner with Arixa. Welcome, Greg. Thank you very much for joining us today.
Thanks for having me, Kevin.
So, the usual format for this podcast is kind of, we're just going to, have some fun, talk a little bit about Arixa, get to know you a little bit better, and maybe talk about some current events and some issues and, get your thoughts on where the industry's headed. So let's just jump right into it. So first of all, give us kind of like, who you are and, what your company, what Arixa does and the usual intro. And then I'll start poking and prodding a little bit.
Sounds good. I've been working kind of in the real estate industry since right out of college, off and on, full-time, started flipping houses in high volume around 2010, and was a very, very active flipper for about 3 years, and met Jan Bresky, who had started Arixa actually back in 2006, but his first fund in 2010. I believe we met in 2011, started working on a single-family rental fund in 2012, and then started working together full-time on the lending side in 2013. Mm-hmm. So been, I guess, full-time as a private lender since then. Hard to believe it's been that long. We've always tried to come at it a little bit differently in terms of how we try to build the platform. As a borrower who's borrowed from many, many, many other lenders, I've always tried to incorporate the things that I appreciated about the lenders I worked with, and tried to keep sort of the borrower-friendly attitude to the extent you could. What do the borrowers really care about? So we've been, an acquisition and construction lender since then. We added multifamily to the business a few years later, and mostly focus on the West Coast. As you know, as a longtime service provider of ours, the business has grown a lot over the years. So, mm-hmm. It's kind of Arixa in a nutshell.
So Arixa has always been a lending company, but you guys have kind of expanded your product offerings over the years, right? Did you guys start in the fix and flip space first, or was it, we started adding, because you guys do commercial real estate now, you guys do construction, you guys do residential. Has it always been that way, or was it just residential only? How did that evolve?
Yeah, it was in the beginning. We lent to the people who bought it to trustee sale. It was very average loan sizes in the $100,000 and $200,000 range. Mm-hmm. And it was very much, I think, a way a lot of folks got started in the business. And the one thing we always did is we always were a balance sheet. We've always come at it as an investment management firm, mm-hmm. An alternative investment management firm. So we wanted our own balance sheet from the very first day.
Yeah.
Which was obviously very constricting when you didn't have a lot of money to lend.
Right.
What really transformed, I think, our business was we partnered with a commercial real estate investor and launched another vehicle called Crosswind in 2013, which really allowed us to do larger loans, mm-hmm. Bigger construction loans. We were doing $1 to $5 million SFR mm-hmm. loans. And we're probably one of the very few companies in the space back then who could do that. Mm-hmm. And I think it really became the catalyst to be able to do a lot more. We've always done a lot of renovation. That's my background, and construction has always been an important part. I think we did our first ground up in 2015, Kevin, I think, mm-hmm. if I'm right. And then multifamily, we did 1 in 15, and by 2016 and 17 added. And by last year, it was nearly half of our business. So we have a pretty nice mix now between multifamily and residential, with a little bit of other commercial assets, but mostly single family and multifamily.
The listeners, our audience, like to learn more about kind of like how you came up as a builder first. You were in real estate right out of college, you said? So
I was an accountant out of college. So calling me a builder would be a far cry, because I don't know which side of the hammer is up. But I was actually, it's funny, my affinity for real estate started, I got a VA loan on the property. I was in the Marine Corps and got a mm-hmm. VA loan out of college to buy an $81,000 house in the city of Indianapolis, where my first job was. And I think I put down $2,000 and I was hooked. Mm-hmm. I was like, wait a second, I get to borrow $79,000. I'm a 22-year-old kid. It's a lot of money back then. And if it just goes up by a couple percent a year, I'm doubling my money.
Right.
So, as a math guy, that math worked for me very well. So
Right.
I bought and sold probably 10 or 15 homes, had a bunch of rental properties, actually sold some rental properties to pay for Harvard Business School, helped to fund my tuition, and then went into corporate America for a very long time. But always, I had a small little real estate fund I had on the side, and was always in SFR, always fixing things and leasing things and renting things. And just, it felt like I'm not a very good stock market picker. I've decided over the last 20 plus years. So I could get my arms around real estate and values, and the math made sense to me, and it's always been something I've had a, great affinity to. And, it wasn't until 2010 it became like a full-time career as an investment, manager, if you will. But a lot of 20 years prior to that, just doing it, as I could with my full-time work.
So it was basically a kind of like a side hustle while you were working in corporate America for a while.
Yeah,
just
I don't know
private
if
investing.
I'm not if I'm cool enough to have a hustle, but yeah, it was not my full-time job. It was not my W-2 paycheck.
So were you like a CPA for a while? Were you doing that, or?
Yeah, my exciting job out of college. So my dad was an engineer, and basically his lesson was, if you're going to spend the next 4 years of your life getting a degree, you better get a degree where you're going to get a job. So you can be an engineer like me, or do something in business. And I was better at math than I was at science, and I liked business and had an affinity to that. So got an accounting and finance degree. Went to work for Pricewaterhouse. Went to work for a big corporate group, and like kind of internal audit, process improvement, and did a lot of traveling before I went to business school. But I actually came back after business school, and I was a CFO for a small period of time in the late 90s. But, I know enough to be dangerous now, not enough to actually do those jobs anymore. But it was a great training.
Well, you recruited a pretty strong staff around. I mean, a pretty strong
we have.
Accounting staff, and your internal, your all those people that I know who work on the tax and accounting, and your CPA team, your audit team. They're all really strong players, and I'm sure you have a say in all that, right?
Yeah, they know a lot more than I do, Kevin. But yeah, we've surrounded ourselves with some, as we did with you guys, people who know a lot more about their subjects than we do. But yeah.
Well, so Greg, right now, currently, what is your official title with Arixa?
Yeah, I'm one of the two managing directors. So John Bresky is the founder, myself, run the business. My primary focus, although we both do a little bit of everything, is really running the day-to-day lending platform. Right. Which we can talk more about what that involves. But we're involved with investors and some of the institutions we work with, and capital markets. But day-to-day, you're most likely to see me with a borrower, talking to borrowers, working with the team. And I kind of describe myself a little bit like an air traffic controller. I've got lots and lots of planes to land. Yep. And we got to bring them all down and get them done on time, and make sure the ride isn't too bumpy, right? And and keep it going. It's it's a high volume business. A lot of transactions.
Oh yeah. I mean, and especially considering you guys are a balance sheet lender, you have to do a lot more work than most of your competitors do to evaluate and maintain and also keep those borrowers happy. And let's talk about that. So, describe Arixa's current structure right now, and how about how we got there. So, my understanding, you mentioned Crosswind, but Arixa is a balance sheet lender. You have two funds, I believe, right? And they're using the REIT strategy. Has Arixa always had funds, or has there been any other strategy before?
No, when Jan first started, Jan's background, he started his career at Goldman Sachs, and I think some of his mentors and advisors said, if you can build a fund and develop a track record, you can really create a very viable, sustainable enterprise. So he's always been track record focused in terms of the investments we've made. If you wanted to go pull our track record, you can see the first loan he did in March of 2010. Right. I think we've done couple thousand since then, but every single loan, the track record is there. It's documented for the world to see. And that's been very much part of his message since the beginning. We run one fund that is not a REIT. Actually, it's an unlevered fund. Our largest vehicle is a levered REIT with a subsidiary REIT. You and I have been at panels to discuss this before. The Crosswind vehicle is a full-on REIT. It's not a subsidiary REIT. It's a top-level REIT. Those are similar size vehicles, and both use leverage, warehouse lines from banks. And then we have a capital markets arm that selectively works with some counterparties on some loan sales.
Right.
Well, that's been a smaller part of the business, but it's important as well.
When did you guys add that component? I know the fund has always been there, but like when did you guys start adding loan sale and liquidity through capital markets?
Let's see. So our Crossland fund, when we first started it, and I'll give all the credit to that to our other partner, Bob Barth. He brought the concept of working with a commercial bank that he knew that was not in this space. This is 2013, mind you. This is a long time ago, when the only player in town was Wells Fargo. And he said, well, look, you're going to make a loan at this time at 10 or 11%, and you're going to borrow the money at 4 or 5%. We can do pretty well.
Right.
So our first 2 years in Crossland, 13 and 14, we were returning 13 and 14% to our LPs.
So you guys were able to get a line of credit in 2013 from a bank?
Substantial one.
That was impossible back then. There were no banks doing credit lines back then in our industry. It was one, and they were charging 8%. So that's amazing.
So it's again, all the credit goes to him and his relationships and his ability to do that. We started with we launched the Arixa leverage fund in January of 14. We got a $5 million line from a very small LA bank that used that. And that was the max. I think we bumped them to 7, and we reached their max they could do. And then we started working with another bank, and that line has grown from 15 up into the 9 figures now over the course of the last several years. Our first loan sale was probably in 2017.
So right around the time it started becoming a trend. Yeah.
And again, we sold a fair bit of loans last year. It's always been, I think all your balance sheet clients have the same issue, which is either have too much money or not enough money, and it's never quite right.
Yeah.
And so I think the one thing we did well, I don't know if we're going to talk about what happened in March of this year, that little kerfuffle that hit us. Yeah. But, the one thing we did do, and I think we talked a lot about it, not knowing what was going to happen, is don't have a single source of capital.
Yep.
Don't be, we have a really varied balance sheet and off balance sheet, and it really served us well at that time. And we'll talk about that if you want. But we were always really scared about having all of our eggs in one basket as it related to capital.
Well, let's talk about that. For the listeners out there who aren't like in the industry per se or on the sidelines, March, April, May was essentially like we were all, some people describe it as doom and gloom. I describe it as everyone just kind of like had their heads down, popped their heads up, and was like, what the hell is going on? I
would describe it as dazed and confused for those old enough to remember that movie.
Yeah. It was like, what is this craziness going on all of a sudden? Because everything on there, like a lot of my clients, like you said the same thing, nothing looks too bad based on what I'm seeing, but the entire industry is losing its mind. And so talk about what happened. March hits, we go into lockdown. California goes into full lockdown. You and I are both working from home. I remember the phone call. I was in my living room.
I'm like, Kevin, what's going on out there? Tell me what's happening.
You call me, I call you. And I felt that's the same way. Like, my clients don't seem to be that worried, but for some reason, there is a sense of doom and gloom out there. So tell me about, how Arixa handled it. What was the decision you guys made, the timelines, and how you guys got out of it.
I'll tell you a funny story. And again, so on the 13th, or the Friday before they closed our state down, we were finalizing a major increase in our primary warehouse line. Called our banker on that Friday, and we're supposed to have docs on Friday, and he goes, I won't have them out to you till Monday morning. Called him again on Saturday. I said, are you going to still have the docs out? He goes, we'll have the docs out. On Monday, we got the docs out, and we added many millions of dollars to our available balance sheet that week after COVID. So thank goodness a bank that stood up and did what they were supposed to do. But that was a scary weekend. I was waiting for them to pull it.
Right.
Well, every reason in the world to pull it.
You and every other lender out there that had a bank line was wondering, are we going to get pulled? So, but you didn't. We did it, and thanks to them. So, the first thing we did is
immediately canvassed our clients. So, I mean, again, we're not a national platform. We do some loans in some different states, but we have a pretty close personal relationship, almost like a private bank would have with our clients. So we're dialing on Monday, Tuesday, Wednesday, Thursday. We're just calling. Hey, Kevin, how are you? What's going on? Everything okay?
I did the same thing. I called you.
You called me. I think you and I probably talked on Tuesday or Wednesday. Yeah. Are you okay? Is everything okay? Don't lose your mind. And we started, we never really shut down. Like a lot of our loans were active construction sites.
Yeah.
So we're just going out. I just wanted to go out and meet. I met people. I didn't really stop going out and interacting with people.
Mm-hmm.
And obviously construction did not slow down at all, except a little bit up in the Bay Area and Seattle and Portland a little bit.
Mm-hmm.
But, just wanted to make sure everybody knew we're going to fund their draws.
Yep.
And we're going to be here. We had a lot of people that, had some funny requests, can you pause all my interest for the next year and not charge me any extension fee? No. But, we had some interesting conversations. We tried to work with the borrowers. Like if you're a borrower who is in contract to sell your property and COVID pushed your sale or something like that, we tried to be as flexible as we can. That's the biggest advantage I tell all my clients. Like you don't really care who holds your loan until you care.
Right.
It's not in a security. It's not in some servicer who sold it to a sub-servicer or sold it to a sub-servicer. We service our own loans. We service our own draws. I did draws myself. I went out and did physical draw inspections in March when one of my guys, couldn't do it. So we're going to make sure if you need us, we're going to get somebody out there. And without having that balance sheet, Kevin, it would have been really hard.
Yeah.
The good news is we haven't had a single loan go into default or nothing has happened since COVID in our portfolio across our entire book.
Really?
COVID, which is crazy, right?
Not even in the commercial stuff.
Nothing. Now we had people that we worked with in March and April and May. So a lot of it was just trying to assess, going through every loan and saying, okay, what are we worried about?
Right.
And we met every commitment we made prior to March 15th, but we didn't do any loans for a few weeks. We really
that makes
tried
sense.
to figure out, we had some redemption requests from investors, which a lot of them actually ended up after time pulling the redemptions. Once they saw that the world did not implode.
Right.
I'm sure you saw that across your clients.
Yeah.
And then gradually started opening up the door again. And
when was that? When did you guys make the realization? Okay, it's time to stop with the whole.
Yeah. Jan, I think he was probably a little later than I was in terms of that. But we turned away some loan requests that were as good as I was joking to some of my clients. It's like it's 2013 and 14 again.
Mm-hmm.
Pricing was, a lot of people,
double digits, right? Yeah.
Yeah. I never tried to do that to people, but the leverage, we definitely cut leverage for a while.
Yeah.
But it was like, it was 2014 pricing.
Yeah.
All of a sudden, but so we did a few loans to repeat clients at a little lower leverage.
Yeah.
I didn't charge them more money. It just didn't feel right.
That's great.
To do that.
Yeah.
But
that's great.
But I said, hey, I can't go to this leverage attachment. Let's go to this one.
Right.
And I think late June, and there was a lot of demand. And then, July was a normal month. August was a great month. And it's kind of gone back. And I'm sure a lot of your clients, January and February were amazing months.
Oh, yeah.
Like 2020 is going to be a kick-ass year.
Oh, yeah. I came into 20. I'm like, this is the year. This is going to be the year. Everyone's going to kill it this year.
By March 15th, I'm like, this year's going to suck.
Yeah,
but, I think we've been lucky. I think a lot of it is, good clients and good communication. And,
right.
A lot of clients showed stripes. You saw clients who were unbelievably humbled by what this had done to other parts of their businesses. Maybe they had a construction business. Maybe they had a lot of commercial property. We haven't been very heavy in retail or office. We have a few, but I have guys who I would never have thought would ever be of an issue, like huge portfolios. Like Greg, I collected 15% of my retail rent this month.
Right.
I'm $250,000 short of my normal monthly cash flow.
Let me ask you a question about that, because you have these relationships with the owners and the developers, and my understanding has been the biggest impact has been actually not the small business retail, but the big box retail. They're like basically saying, like Best Buy is basically saying, no, we're not paying rent. Yeah,
I think it's across the board, Kevin. I mean, I've got one loan down in San Diego. The guy's got a Mexican restaurant and a bar.
Oh, really?
What do you do?
It's true.
I mean, it's like, I think the strip mall owners have had it bad too. If you just think about businesses that are walk-in service businesses, those
That's
have been
true.
hit.
Brick and mortar retail, any kind of brick and mortar retail is tough right now.
But imagine offices that are coming up on, renewals.
Yeah.
Or earn revenue through other things like parking, and it's pretty tough out there. I mean, we don't do hotels, thank goodness.
Yeah.
I think that's been as hard hit as anything.
Of course. The hospitality industry.
We have one in downtown LA where it's got a mix of office and retail. But I think the retail was like, I won't get this right, but like a coffee shop, a gym, and a juice bar. And they signed all these leases, and then nobody wanted to move in.
Right.
I think they now subsequently have, but my sponsor's like, okay, wait a second, that wasn't my business plan. I signed all these leases, I'm ready to bring everybody in, and nobody could actually come in. So I don't know if we're going to talk about how the SFR market has been performing, but we're probably better lucky than good as it relates to the asset classes we've been in, just because they've been.
We'll talk about that. So what was the so before right before all this happened, right? What was the kind of the ratio? What percent were you in SFR versus commercial, that kind of stuff? Because that's something that a lot of people don't think about. Like, how do I balance my portfolio if I'm going to be doing, multiple types of, loan classes?
Well, so obviously our commercial loans are much bigger than our SFR loans.
Sure.
Our average loan size is probably surprising to a lot of people. It's well above $2 million.
Right.
Our average loan. So that could be a $10 million multifamily. That could also be a $10 million single family.
Yeah.
And we still do $100,000 loans, $200,000, $300,000 loans too. But we're not the high volume shop. We're not the shop doing 150 loans a month. That's just not our business. So last year, on a dollar volume basis, we were pretty close to 50-50. Most of our sponsors starting in March just shut down. I'm not buying anything else. I'm not refinancing anything. I got to make sure I can collect some rent. So we had a number of loans. I think the scariest part for us in March and April, I'm sure most of your clients, we have a pretty steady, I don't get it perfect, but I know what my payoffs are going to be pretty much, right? So I'm going to get X million of dollars or tens of millions of dollars in payoffs. All of a sudden there was none. Like nothing paid off in April. Like literally nothing. So, okay, is this a 1 month thing? Is this a 2 month thing? Is this a year thing? So a lot of our caution was, we had to make sure we can fund all of our draws. We have to keep every commitment.
Right.
So I think that was our biggest caution flag was, when are the payoffs going to start again? They really didn't start in earnest until June. A couple trickled in May. But then all of a sudden, July, anything on the market moved. So this year, I will say that our origination volume is probably 80-20 SFR. And most of the multifamily is bridge. We're not getting a lot of the, last year it would have been, you buy an older building, you relocate tenants, you fix it up, and you re-tenant it. Most of our sponsors kind of took a break this summer. They wanted to see what's going to happen with the election. They wanted to see what's going to happen with evictions, which in, California and some of these Pacific Northwest states, there's a lot of state mandates coming out, as you know. It's not an easy circumstance for them to operate in. What I will say is rent collections, which were down in April and May, are back up to pre-COVID levels for most of our clients, which again doesn't make a lot of sense.
No, it doesn't.
We're not in the high-end space. We're not doing downtown LA, amenity buildings. We're also not in the, kind of the really low rent. So we're kind of working class. And, I think a lot of those folks have been able to cobble together their rent. And I've been constantly surprised. I have a couple guys with buildings where like, I haven't missed a single rent. Like, come on, I don't believe you. It's like, the tenants that we have, they're doing things that they're working like you and I are doing today, and they never missed a beat. So it's just been a lot of things that if you and I would have talked about what would happen if we shut down the economy, I don't think we would have expected to see some of the things.
Well, we all expected like multifamily to suffer in May and April. May, I was expecting a lot of, the rental market and the SFR rental market and the multifamily market to suffer significantly. And come end of May, we started realizing, wait a minute, this is 100% impacting commercial real estate only. SFR is not skipping a beat. Multifamily is not skipping a beat. Everyone seems to be able to make their rent payments. Some people were like, yeah, it's a stimulus. I'm like, but that was like $1,200. It doesn't make a difference.
Not in your $3,000 a month rent.
Exactly. We're in LA. Yeah. Month rent here it's expensive. So I think, I think a lot of people found a way to make it work.
I think you're right. One, I also think that I've also started to see now there's been some transactions and a lot more refis. Multifamily values haven't fallen.
Yes.
So that's the other thing. I thought you'd see a 10 or 15% decrease, but with interest rates so low, cap rates have continued to stay super low.
Yeah.
And for the most part, I'm seeing some appraisals more and more that are coming in. They're at or above our pro forma values pre-COVID.
Yeah.
And in some cases are above the expectations of our clients on their pro forma values, which again defies a lot of logic. You hear about that in the SFR market. Obviously, it's red hot across the country. All your clients are seeing that. But the multifamily has performed. It's been a much more durable asset than I think.
No, a lot of folks have been reconcentrating into multifamily, and I kind of left myself scratching my head because it ultimately boils down to what you said. Cost of money is so low on the refi and on it's just, and the agency loans are still there and everything's still available. So there's no reason not to do it, and rents are being paid. So if you're investing in B class apartments, cap rates are good, interest is good, values are still solid. I mean, we're seeing valuations not only stabilize. We were worried about a dip in valuations. We didn't see any until like we came out of tail end of May, and we only saw it in commercial. Right. And that happened to funds as well. We were waiting for corrections to happen in funds. I watched certain larger funds to see how they're going to perform as an indication of our client bases, and none of them announced any losses or deductions until we saw the ones in the hospitality space start to mark things down. And I was like, oh, that's a hotel REIT. That makes sense. Mm-hmm. And it started becoming kind of a question mark, like what is going on? And
you certainly saw the mortgage. The mortgage REITs got crushed.
Yeah.
Between March 15th and April 1st, the one asset class you did not want to hold was a basket of mortgage REIT stocks because they had the dislocation, which hurt our industry a lot.
Yeah.
A lot of your clients who worked with some of the publicly traded REITs, and there was some real liquidity concerns in that space.
Yeah.
Like, are they going to make it? Kind of questions.
Oh yeah, I mean it became a question mark. What is causing the crisis upstream when at our level we feel things are doing well? And personally, I kind of put the fault at the foot of the repo lines, but a lot of bad repo lines out there. But I mean, it could also be the way they're invested, the way they're levered, the amount of leverage they have.
Yeah, we've always been we're trying to operate at a 1-to-1 ratio. We're not trying to triple or double, do 3-4 times leverage. And it doesn't take much of a move in 3 or 4 turns of leverage to really put that equity in a bad shape. So,
yeah, if you're 3x leverage, then you're really gonna any spike is gonna hurt you. So let's talk about kind of building the business, right? Because you guys have a pretty sizable staff now. How many employees now?
31.
And you guys are lending in about 10 states right now. 5-10, is it 5 or 10 states? Give or take.
Yeah, we've got loans probably in about 10 states, but really operating probably I would say 3 that you would see us.
3 core markets, right?
They're active, yeah.
Right, and big name in LA. I mean, everyone knows Arixa in LA and Orange County as well, and even in the Northwest, some of my local lender clients have mentioned you guys doing very well up there. So, but having the amount that you guys have under management and pure balance sheet, tell me about the kind of the hiring process. Like, who are some of the key hires you guys had over the years? Because I mean, initially it must have just been a skeleton crew, right? Just a handful of people.
For far too long, Kevin. Let me
tell me about that. Yeah.
Far too long. So, yeah, I mean, I think Jan and I both have a similar history in that we both started, he started and I joined very early high-tech companies in the late 90s. Mm-hmm. He sold his company to a public company. that then kind of got caught in the boom. I was pre-IPO, ready to go on a roadshow in April 2000. Canceled all those flights, as you can imagine. And, we both saw a massive change in what our paper net worth was to, what it ended up being. And we both were saddled with very large staffs and large overhead. In my case, big name venture capital firms that wanted, it was go big or go home.
Right.
And he and I both, as we got older, neither of us wanted to go through that. So we probably, in retrospect, hired too slow. We underinvested in the platform because we wanted to make money every single month we were in the business, and we have never had an unprofitable month. So, so as we started to staff, I think our MO was hire as many Swiss Army knives as we can. People who could do a lot of different things.
Right.
And some of our longest standing employees now, and you've met some of them, they might have started in an admin role or a processor role and have moved around to credit or origination even, or, other roles. And, they really learned the system and how we do things. And we do things pretty differently, as you know. We've hired, senior people in operations and, obviously finance staff and legal staff and those. But, we were a pretty large company with a staff of 15.
Yeah.
And, I think, now we've got some newer hires that we, a couple that we haven't even announced yet, or just very recent. I think now as we look at the business, I think COVID has taught us maybe where some of the gaps were. I don't know if you guys have seen that in your business, but, things have, I wish I had somebody who could do that, or, maybe making some changes to the organization. So that's been more of the focus over the, the last few months. Obviously everybody we hire on the originations side is it's the key. We're not big marketers. I mean, I wish we had your marketing acumen. You guys do fantastic things.
Oh, thank you.
It's
all marketing team. None of my, I'm
not assuming that the top attorneys at Jurassic are marketing.
We don't know anything. Our marketing team is top notch, so they're fantastic.
But we've tended to be, we're pretty quiet, as you know. I mean, we depend on our loan origination staff to forge relationships, build ties,
right?
Get referrals. It's a very much of an organic growth. So, each of those people on the origination team have been huge parts of our business. Our originators carry a very large book. Of those 30 people, we have very few people that actually do loan origination. It's probably a shockingly low number to your listeners relative to, a lot of the companies that are our size. So we expect a lot out of each person. So each of them have been really critical hires. Some really strong people in credit, great closing team, and more what we started to do. And, we've actually been hiring some people from some of our, who have left, not poaching by any means, but have left some of the better lenders in town, if for whatever reason. And, I think that institutional knowledge of some of the shops that we have a lot of respect for have been great additions to our team.
Nice.
And, we're all doing the same thing. We're just doing it a little bit different way. But,
right.
We've had some closers and some credit people and some folks I think have brought some great insight and perspective to our platform. And, I don't envision us going from 30 to 200 like some of these shops have. And that's just not what we're trying to do. But
right.
We'll continue to grow and continue to add staff. And, we certainly have growth, a lot of growth in front of us. It's just, I think we'll always be a little bit of the slow high,
lean and mean, right? I mean, you guys came from the world where it's too overstaffed, and we were overstaffed, and we felt it too. Like, what can we do? How can we do more with less? As COVID came around, and
the technology has really lent itself to that. I mean, I was running a large servicing business during the financial crisis, and I watched people who had been at companies for 20 and 30 years in the mortgage business, begging me for a job as a call center rep.
Yeah.
This is the only job they could get, in the industry in 2008 and 2009. And our industry has been, has a horrible reputation for staffing correctly. We either hire too fast or hire too slow.
Yeah.
But it's really a difficult balance. So I think we want to build it organically. I think this. We don't have a an institutional owner or a private equity owner. So we're one of the larger, maybe we're the larger independent platforms. So it's really up to us in terms of the growth we want and the culture we want. And,
right. And from a platform standpoint, I always talk about you guys as kind of an example, because you guys have taken it very. You built the company organically, but you also have, you don't have someone. I mean, you have people who you and Jan can both do both sides of the business, but you're concentrating, highest and best use almost, right? You have the deal flow and originations, and you're managing the operations, and there's a lot of necessity for that. And we see a lot of operators think about how do I grow my business, and also how do I build my team so we can concentrate and grow? Because a lot of them, I still have a lot of clients that either they're too small or they have too many staff, but they don't have people who are at the executive level helping them actually move the ship forward. And talk about that. I mean, I know you and Jan, you mentioned you have another partner. Were there any other kind of senior level hires that really helped move the ship forward, or move the ball forward over the years?
Sure. Yeah. I mean, we hired, we hired Doug, who came from Patch of Land. He's been a key part of our operational team. We hired, our head of capital markets, investor relations. He came from PennyMac. Dan, we brought on, good general counsel. Strong accounting and finance team. We have a lot of people. I mean, you've met Christina. Christina's been with us for 8 years. Oh, yeah. She's very talented and been in a lot of different roles. So, I think one thing we've done well, we've hired some really good people who maybe didn't have the skills or experience at the time, but had a great attitude and a willingness to learn. And they become that's
what I wanted to ask you about that as well. How do you select these people, right? What are you looking for in these people?
Yeah, no, it's a good question. And I will tell you, when we first started, it was you're trying to find somebody who's willing to take a leap and jump onto your island with you, because you didn't have a whole lot. I can't pay you very much. I don't have much, much I can guarantee you. But,
right.
I think you're looking for people that are smart and curious, willing to ask questions. The other thing that we really look for in hiring is you got to have a service mentality. We bang this across, their heads all the time. Look, getting a great client, this is, if you're going to be a balance sheet lender, getting a great client and keeping a great client, it's probably the same in your business. It's hard to get great clients. You're going to do everything you can to keep them.
Yep.
Because if you keep great clients, and look, and I've been a huge advocate of you guys, and if people ask me, I've referred you business, as you know, that is worth your weight in gold. And that's how we've built our business.
Yep.
And if you have a really terrible experience, it can, go the other way 10x.
Yep.
So, so we really focus on finding, just like we find the right employees, we're very particular about the clients we work with.
Mm-hmm.
I get great loans all the time. It's just not our loan. It's not our borrower.
Mm-hmm.
So as much as with the employees, we're trying to find the kind of borrowers who appreciate what we do and how we do it, and will be long-term borrowers. And I got to talk to a guy before this call. He's been borrowing with me for 7 years.
Wow.
He texts me and says, "Greg, I had a quick question. Can you give me a call?" I haven't talked to him probably in a year, but it's he's been working with us for 7 years.
Right.
So he knows what we do. I know what he does. 5-minute question, but he feels like he got some love.
Right.
And I talked to him forever. So that you can build a great service business. I'm sure you guys are the same way.
Yeah. Law firms and lending and balance sheet lending businesses, at least, are very similar. It's a service business, book of business oriented. If you keep your clients happy, they will come back.
They're a great business. Well, and I think this. We do our own draws and we do our own servicing.
Yeah.
We're one of the only guys who do that. There's a couple other, Steve, who you talked to before, he does as well.
Yeah.
I don't want anybody else interacting with my client ever.
Right. Controlling the interaction.
I want to control every interaction.
Yeah.
If that interaction is not up to your expectations, I want you to tell me about it. If you didn't get the service, the response, the answers, Jan or I will take a call, or one of our other senior people will take a call. It's just, we expect that service interaction No, it's not always between a lender and a borrower. It's not always a kumbaya, right? I mean, you might have to deal with issues, but I want you to deal with it in a way that still maintains the professionalism of a high quality institution. We really tried to raise the bar in how those interactions happen.
So would you say that that's kind of like a core value of the company when it comes to service oriented?
The exceptional service, white glove service. We have an award we award to our employees for who provided exceptional service voted on by the employees. It really is something that we celebrate and talk about. And
that's great.
When we have something that goes the other way, we talk about that too. I mean, that's a learning experience.
Right.
But that's a really important part of what we do. And, if I lose a client that I really want, I mean, I take it personally.
Yeah. And it stings because you work so hard to build that, not only culture, but, that relationship. So, I mean, and it can go sideways with just one bad interaction. Right?
It isn't you or me. It could be somebody in your staff. It could be your administrative assistant. It could be So it's got to go from top to bottom, I think, if you're trying to build that kind of culture.
100%. So, I mean, right now with 30 employees and, you guys are, I mean, not only stabilized, but you guys are growing, LA markets and Northwestern markets have stabilized. Things are looking up. Let's talk about where we're going. Where's Arixa going? What's the plan for 2021? What are you guys excited about?
So we are going to announce we're going to have an institutional separately managed account in 2021. A pretty high profile investor. Mm-hmm. I think that will be more in the commercial space, but that's an exciting development for us. And I think it's a long time goal of Jan's to, really bring most of our investor base. We have close to 1,000 investors, are mostly retail, mm-hmm. some family offices and RIAs, but it's not traditional institutional LPs. So we're excited about that. I think there will be some new markets that we're going to go in and try to replicate the strategy that we have, which we're excited about as well. But I can say probably for the first time in probably 4 or 5 years, it finally feels that we have our capital sufficient and right-sized for origination. I've spent many, many years kind of chasing my tail, or we've been chasing our tail, where, you have more origination demand and interest than you have the ability to capitalize. And it's a frustrating place to be. It's a good place. You'd rather have
capital
more.
Constraints are always and that's the reality for balance sheet lenders. It's always more deals than money.
Yeah. Well, I don't know if that's the way for everybody, but it certainly was.
Well, I mean, the trend tends to be the ones that are, having service oriented and, but
going into
as a balance sheet money, not Wall Street money, but
not Wall Street money. There's always plenty of that, but
plenty of that.
So going into 2021, I'm excited about some of the new staff and really feeling like the business is well capitalized to, to really take care of the clients the way I'd like to take care of. And we're winning a lot of new clients. I wish I had the answers. My LOs say it's all them, and maybe it is, but we've been able to acquire some new customer relationships over the last 3 to 6 months, which I'll be honest, I think before COVID, I don't think there's any way I would have been able to win this business. Mm-hmm. And I can't put my finger on it. I think it's different across different organizations, but there were, I think our industry struggled between, we're not a giant industry with, tens of thousands of staff that you can, I think we stumbled a little bit between March and June. I think some companies failed to, keep their engines running the way they were, had some missteps, and maybe soured a few relationships.
I think so too. I mean, I definitely think a lot of key players either created, like, their exit or their failures created some kind of vacuum. But
it feels like that. And I'm hearing, I've heard some horror stories of things, and I'm not going to put anybody out here, but of companies I hold in high esteem who really, really let some clients down, like long-term clients, just not meeting commitments and not responding the way you and I would expect them to respond. And there could be 1,000 reasons for that, but I'm excited about some of these new clients, Kevin. I mean, clients who do 10, 15, 20 transactions a year, really experts in the markets or the products that they are. And you can build a hell of a business with those kind of clients.
Yeah, exactly.
I like to say, 50 clients doing 20 million a year with me is $1 billion of business. So
exactly. But
it doesn't take 5,000.
And but that's a credit to the stability that you guys had during the crisis. Because what I was finding is there were some people that were like, the reaction, the reaction felt like some interactions as if '08 was happening again. I'm like, this isn't '08, guys. This doesn't feel like '08. I kept saying, this doesn't feel like '08. This feels a little bit weird. This feels a little bit strange. It's not. This is a crisis, but I don't think it's '08. But some people were just.
I'm glad you were right. I don't want to live that again, Kevin. I don't want to go through that again.
I was being optimistic, and and people were calling me, "You're being optimistic." I'm like, I don't know, guys. I mean, this is all kind of like artificial almost. Like this is the government forcing us to stop. Like it's not like the values have just tanked all of a sudden. It's not like all of a sudden.
It's not like all of a sudden there's 100,000 homes. I don't know if you remember in '08, you put a home for sale and it was like crickets.
Yeah.
You couldn't give it away.
Yeah. I mean, the inventory comparisons were,
no inventory now. Yeah, no inventory.
And that was the one thing I was telling people, like, there's still so little inventory out there. I mean, simple thing, go onto Zillow and watch the house values increase. And
they have.
They have. My house went up 20% during COVID. I was like, what the hell?
It's like Tesla stock. It's like Tesla stock over there.
It's like Tesla stock. Yeah. I know, no joke. And it's one of those things where we were talking about, like, this is different. This is very, very different. And I think that the funds and it's interesting because I'm in the fund business, so fund formation business.
Yeah.
All of the clients that were managing, about 20 to 100, right? Everyone did okay. No one really suffered that much. I haven't seen a single one, except for the hospitality funds. I mean, that's the difference.
I understand.
But if you're in the mortgage fund business and you're balance sheet lender and you stayed, disciplined and customer service oriented, all of my clients seem to be doing well. If not, they're excelling. Like we have one client in Arizona, like it allowed him to grab so much market share in his local community that he basically was able to, similar to yourself, he would attract a big institutional investor. It's amazing what people are doing, I don't know. I don't know if it's optimism. Do you think it's optimism? I don't know what it is. I mean, is it stability? What is it? I mean,
look, I think the one thing, look, if I'm trying to glean lessons and, so look, hopefully we never have crisis management involving a pandemic in your and I's professional career.
Yeah, seriously.
But the one thing is, I know you did this too, is like, you listened to your clients, you had empathy for your clients. You could tell that you care, and you don't feed them BS.
Yeah.
So a good client would call me and say, Greg, I need to do this loan. I'm like, look, Kevin, I can't help you right now. Here's why I can't help you.
Right.
As soon as I can't help you, I'll let you know. And just trying to be direct. I mean, we were hearing stories of people were calling their guy at XYZ company and nobody answered the phone for a month.
Yeah.
Like, they never got a call back. We heard some stories of lenders being overly aggressive, worrying that they weren't going to be able to foreclose. And I was like, that's not what you want to do here. This guy's you're going to burn that bridge forever. Well, and we saw clients who needed capital. Basically, we saw a bunch of these. April 30th, your loan's matured. You need to pay it off. Well, I can't. Okay, here's the NOD. I'm going to foreclose on you. Just almost like they were trying to capital raise through payoffs.
Yeah. And
boy, that doesn't sit well, Kevin. That's a customer loss.
Customer service.
It's customer loss for life.
Exactly. You burn that bridge. You basically did him dirty, and he's never gonna. Why would he? Especially in this market, especially if you're in the Southern California market, there's so much competition. I mean.
I don't think I'm the smartest guy in the room, but I was just trying to treat people, the little bit of
it goes to the integrity thing, right? We talk about integrity and just be there for people and be honest
and care about their well-being.
Exactly.
I didn't start with, hey Kevin, how's your fix and flip project? How's your family?
Right.
Is everybody safe? Is everybody healthy? How are you doing? You holding up okay? I mean, just people. I just think it's the right way to treat your clients who are the lifeblood of your business.
Right. Well, speaking of family, I do want to bring this up because You have a 3-year-old, right? He's a 3-year-old. Our kids are the same age. You have a 3-year-old, right?
My son was born in June of 12, or June 12th of 2017. So 3.5 years old next year.
3.5 years old. So my daughter was born in November of 17. And I remember we were having drinks in Las Vegas talking about having kids, and the craziness of that. How's that been for you during all this nonsense? Are schools open? I mean, is he in school or is he?
No, he's not. He's not. So I have an office that's about a mile from my house. So I get a little bit of sanity. I'm probably been in the office and out more than you have.
You're doing what Nima's doing that. He goes to the office every day.
It's really, so I can actually, I go to my office so I can work, but I'm also out almost every single day with clients. I just have been,
nice.
My joke yesterday was I was having an illegal private gathering with people outside of my household. So don't ticket me for doing it.
Yeah. All of a sudden you get a ticket from Gavin Newsom, right?
Yeah. I was illegally meeting with 2 clients on their project site, but no, I mean, being a dad, I mean, I'm a lot older than you are, but being a dad has been, a giant change in my life. He's amazing. He's at the age, I'm sure, your daughter is too. He's in his, what is this stage?
Oh yeah.
Daddy, what is this? Daddy, what is this? Daddy, what is this? Daddy, what is this? And, just learning, he's learning like a sponge, and it's been a lot of fun as a little boy. And, I mean, I just wanted to be able to interact with kids again. I'm sure you're the same way with your daughter. And just, I wish you had more of that to do right now. So that's the biggest.
You can't go out and do anything. Like you can't. Like they opened a playground near me, and I was like, thank you God, because like, what am I gonna do in the house? I had to buy like a swing set to put in my house because I have
a trampoline in mine.
Yeah, because what else? What can you do? So yeah.
Well, he won't wear. My son will not wear his mask. He will not. I don't know if
it took me about 3 months to get her to wear a mask.
He will not do it. So it's like I actually took him over for the Apple conference, a couple weeks ago, and it's like, he's a big boy, so I'm like, I'm going to run him through the casino because he won't put a mask on. I'm like, what are they going to do? They're going to throw him out. They're going to kick my son out of the casino. I don't know. Get out of here.
Do they care at all? I mean, they don't care with kids, do they? I mean, it's not a big deal with kids, are they?
I don't know. I just, a lot of these places are no mask, no entry.
That's true. Yeah.
He's a big boy.
I remember.
He's a lot bigger than even you saw. So I just, that's the challenging part. But being a dad, it's been.
Well, they're never going to do what you want, right? I mean, it took my kid, 3 months for her to. And it only worked because there were all these other girls at this one place we were going to. And they were all wearing masks. It was cool. So she started, okay, I'll wear a mask now. And now she asked for her mask. And now it's
maybe we'll get there. But
you'll get there.
Home, the good thing is, obviously you get to see them a lot more than you ever would.
That's true.
But it's still challenging, to
patience. Patience is the hard part.
Dad's home, let's play, right?
Yeah.
No, dad's home, let's work, because dad's got work to do.
Yeah. No, I've had many times, I'm in my home office, for those who don't, this is fake, and many phone calls, and she just comes running right in. Thankfully, we started school. Schools here are open, so it's been better. It's without school, my wife would have lost her mind. So
yes, I do these weekly production meetings. Every once in a while, I got 20 people on my Zoom call. He jumps up, climbs up on my lap, waves at everybody on the call.
Nice.
So they all know him now. So.
Nice. There you go. Right. Very cool. I want to kind of talk about, we talk about kind of some of the issues that came up during the pandemic and some of the legal changes. You mentioned some of the foreclosure regulations. One thing that I want to bring up, because it's something that, I think that you probably have some insight on, is some of the local regulations in California that have come up in the last election, these ballot measures. One of them is a tax-related one. They're adding a tax to essentially they're adding taxes to properties that shouldn't. Basically, they're raising taxes on real estate, on commercial real estate, and all types. I think it's Prop 19. I really want to get your take on it because you guys work so deep. You guys have so many relationships in the LA area, in California, and a lot of these folks are, working with legacy real estate. And so, how do you think it's going to play out? And give us your thoughts on it.
We actually just put this in a recent investment commentary for our investors too. So, I think what you're referring to specifically, there are three ballot propositions this year: 15, 19, and 21. 15 and 21 did not pass. For those listeners who aren't California residents, we have a 1978 law on the books called Proposition 13, which limits property taxes to a 1975 and 76 assessed value with an inflation index, but it increases property taxes. So unlike a lot of states around the country, let's say you and I are neighbors. I've lived there for 20 years and I bought the house for $100,000 and you came in and you bought the same house for $1 million. Your taxes would be 10 times my taxes, even though we live in a house of similar value. So what it does is it keeps people in their homes for a very long time in a lot of ways. So Prop 19, which did pass, was the only proposition that passed, basically allows portability for people 55 and over to move out of that house and keep the property tax break that they had in their existing residence. So this was very heavily pushed by the California Association of Realtors because there's a lot of people who would like to leave their homes and maybe go to a new home or even downsize, but feel trapped by the property taxes and the amount of taxes that would go up in their monthly expenses if they moved. So that passed, but what also passed in that same proposition is, let's say you and I, decide to give our property someday to our children, they would have gotten until this proposition passed, they would have held our basis. So, you have a $10 million house and you bought it for $1 million. It's, you could have passed it on to your heirs. And to just give people a sense, I think the numbers I read in the last 10 years have been over 650,000 properties in the state of California that have been inherited or passed, transferred, and the lower basis stayed. So all of a sudden, these people are now in 2021 going to have their property taxes assessed, not based on what was given to them, but based on the current value. So we believe this could be a giant tailwind for our fix and flip investors and new inventory of older homes finally coming on the market, which is exactly what we want.
It's always been a problem in California. Well, aging inventory becoming part of the inventory out there for builders.
It's been a huge issue, right? And that's why so many of our cities, for those who don't live out here, you have like beautiful home that looks like it was built in 1955 and never changed.
My parents' neighborhood's like that. It's literally like 3 houses down. It's like a shack. It's like, what?
Right. Well, and again, if what you're seeing, there's a lot of funny stories. I think they called it the Big Lebowski because Jeff Bridges had a house in Malibu that he inherited, and there's a funny story about that one. But you could have a property that you're collecting huge rent on that you have no property taxes on.
Yeah.
So the question is, do you now as an inherited homeowner in a second home, third home, whatever it might be, does that make sense for you to keep it? Or does that shack suddenly go to the market? One of our clients buys it, turns it into the other beautiful house like the other three, and creates additional inventory and new inventory. And
this only applies to residential, or does it apply to everything else?
Just that so far. So we'll see how it plays itself out. I just think if you really go through the math of what this looks like, we think there could be a really interesting push of inventory when that math starts to come to these property owners who have inherited appreciated property. And we hope, look, that's the beauty about our cities here, San Diego, San Francisco, Orange County. It's just old stock.
Yeah.
Not everyone in Orange County. You guys have some newer cities down there.
But still, you get a lot of aging inventory out here. Even in the new cities, it's old neighborhoods, and they have to figure out what to do with them.
Yeah, and that's what our clients do. So I think Prop 19 will get a lot more information about it. I don't think people look at Prop 19 like maybe you and I would look at it. I'm thinking about it not for 55-year-old and older being able to be portable. I'm thinking about inventory.
Right.
Creating opportunities.
Critics of the bill were basically talking about it as a wealth tax or an inheritance tax or something like that. But, it incentivizes releasing the real estate to the marketplace. So, it's one thing that's good, so.
It is one good. It is an inheritance tax. There's no question. But I do think for what we have, and California, it's been very well documented. We have a giant inventory, giant supply shortage. We need more homes. Young families like your family, they need homes.
Yeah.
Our clients need to be there to help provide that inventory. So I really do hope it unleashes, we can absorb hundreds of thousands of properties in the next 3 to 5 years if they bring them out without even missing a beat.
I mean, that's been the challenge is that, they're building new communities, but they're too expensive, right? Or they're building,
or not where you want to be. I don't know about you. I mean, there's something about living in a neighborhood with a sidewalk and people that have lived there, and, as opposed to like going 25 miles away into a greenfield subdivision.
They're doing that here where I live in Brea. They're building in the old oil fields, and it's literally in the mountains. You're surrounded by those grasshopper things.
Yeah.
And it's just like, it's not really Brea. You're not really in a community. We live like right next to downtown Brea, and I couldn't imagine living up in the hills like that. And it's a brand new division.
You want to be in a neighborhood, you want the charm, so I'm excited to see what happen. And this is all through California. This is, to Sacramento to San Diego, and it's not it's a statewide.
It's a big problem in the Bay too. You have a lot of aging inventory in the Alameda County area, a lot of old properties in Sacramento. So I mean, it's
San Diego,
San Diego too.
Escondido,
Yeah. Well, that's great. Actually, I one of the insights that I wanted to get on that was because I viewed it from a tax standpoint, and I'm always like, wait, how does this impact my clients from a tax standpoint? But you made a good point. It releases more inventory into the marketplace, so it incentivizes the sale of real estate. So,
which also helps the property values for all the other people around there, right? So,
So talking about the impact on long term. So let's talk about where the industry. I want to get out a crystal ball as we close this great interview. And you've been in the industry long enough to know this real estate is cyclical. The pandemic did not necessarily negatively impact values that much. So where's our industry going? Where are we going next year? What do you see?
Well, look, I think the one thing you and I have both seen in the last 3 or 4 years is, look, there's consolidation happening. Yeah. There are big shops. Finance of America, Blackstone got a publicly traded SPAC. So you now got a publicly traded company that does what we do. Corvest, it's a great company. 5 Arch, great company, both acquired by a publicly traded Redwood. You and I both know folks that are trying to roll up platforms and purchase companies. Obviously, Genesis was purchased by Goldman Sachs. Anchor is owned by Wafra. So you've got very, very large institutional players, and some of these platforms are backed by very large institutional players. None of them strike me as being low on ambition. So, I think you're going to see a pretty steady dose of consolidation.
Well, that's what we were hoping for. That's what we were expecting this year. Not hoping for.
This year. Nobody did anything this year, really. But you saw Broadmark have a public REIT. It's been quite successful.
Yeah.
So I think on all accounts, and obviously they got hurt in March, but they've rebounded nicely. So I think consolidation and scale and again, as the capital markets get more and more sophisticated, more and more commoditization of what the programs and products look like. That I think if you and I looked at what people were offering in February, if we said send me your term sheet, they all would have looked the same.
Yeah,
everybody was providing the exact same product and pricing and leverage, and so it feels like we're moving down a path of scale, commoditization, institutionalization, if that's even a word. Of this being a really important part of the alternative investment universe. You're seeing Apollo, Athene, giant players who have, massive fixed income portfolios, KKR, who's behind Turek. These are some of the most sophisticated investors in the globe. And they've honed in on our strategy.
Yep.
They like it. They're making investments. They're building platforms, investing in platforms. So that momentum seems to me like we're almost like where the SFR rental space was maybe 5 years ago, 6 years ago, when you first started to hear about Invitation Homes and American Homes for Rent. Now these are massive companies, right? Very, very large value creation. Feels like our industry is getting some of that, maybe pixie dust sprinkled on us. If I was to maybe draw the comparison.
Yeah. I just hope that we don't end up in what I kind of call like the the standardization that you saw in the conventional market, and like, the domination of, agency and kind of everything being designed to revolve around that. I just hope, I like the fact that our industry is kind of fractured still. Well, actually, I think it's still pretty fractured. I like it because it creates a lot of different avenues for entrepreneurialism, and you have a lot of different strategies that come out. And if standardization becomes, once you get commoditization, you get standardization, and a lot of lenders don't do the same types of loans, and I like that.
I'll be the last man standing. I'll be the survivor, kicking and screaming, because my entire value proposition, and anybody who's ever dealt with me knows, I don't have a term sheet or I don't have a pricing sheet or pricing terms.
Right.
I have a conversation.
Right.
And my job is to find something on my balance sheet that works and is a solution for what you need, and hopefully I can continue to do that as long as I'm in the business. And and
because if we start operating off of fixed matrices, then we're no different than the conventional market, and we're
but you and I both know most shops who have heavy capital market and loan sale businesses, they do, and we know them. You and I both know. It is. It's a very. The securities that are coming out now. There's a lot of securitization being done.
Oh yeah, that's a different.
Those are very defined. It's. I looked at a tape the other day, and it's a remittance tape. It reminded me of 2007. I got FICO bands, and I've got this band and that band. And
that's true.
It was 2007. It was like a sub. I don't want to call it this. It was like a subprime securitization table.
No, it is. It was exactly the same, and it's our industry's product, like fix and flip. And,
exactly. So I don't want to be that. The fun of this industry for me, and anybody who knows me, I love the structure. I love the deal, the art of the deal. Let's talk about your projects. That's what's fun for me.
And that's what I worry about, is that we lose that appeal. A lot of balanced lenders feel the same way. And you get commoditization, you start losing that ability to be nimble and flexible. And, hey, if this guy's a repeat borrower, maybe we can do some extra things for him or whatever, So
whatever it takes to, So hopefully that doesn't happen until I'm retired and out of the industry and have my feet up on a beach somewhere. But I think it's coming. Look, I think that most people are going to end up going to where the money is the cheapest. And
that's true.
Capital markets and Wall Street, they tend to productize stuff, and they're very good at it.
Yeah, that's very true. Well, Greg, I think that's all the time we have today. Thank you so much for your insight, and this was a lot of fun.
All right, Kevin. I always enjoy talking to you.
I know, right? When are we gonna hang out next? Is it gonna be Vegas? Is it gonna be Newport?
Well, no, I can take you to a coffee because Pasadena's open. Other than that, I can't take you in LA County. So I think that
Orange County's open.
I think in Orange County I could buy you a beer in Laguna, right?
Honestly, a lot of the places here are saying, until the police come, we're not going to stay open. So
not quite that way in LA. I have to
yeah.
So,
well,
hope to see you soon, Kevin.
Hope to see you soon, and we'll be doing a live event soon. So you definitely will see you there. So,
all right,
I'll talk to you soon, Greg. You take care.
Thanks, Kevin.
All right, bye.